Hi, everyone. I thought I'd put together a very quick market update with a few slides, really directing towards what is happening in the geopolitical world at the moment. There's certainly a lot of heightened tensions now with the Russia-Ukraine environment, but also with rising inflation, and it's creating an awful lot of uncertainty. And while it's natural for you to want to look at your portfolios and make a relationship between the geopolitical concerns, I thought I would spend some time looking more at the economic sides and also a little bit of history. So bear with me as we go forward. This should only take a few minutes. As we don't like to talk about these things, the reality is geopolitical events are a very common occurrence over history. And we also tend to forget that as they've affected us, you can see that in the S&P 500 in particular, that the markets have always continued to recover other than 4 times in history, which were a recessionary event that had already begun at the same time as one of the geopolitical events. While we do look at the Russian-Ukraine as something that is very difficult, we do not see it as a true economic challenge at this time. We could expect things like rising oil prices, but more importantly, we tend to call this an exogenous event whereby the impact is short-term in nature. Now, I don't want to be, again, belittling the situation. It's just really having a look at history, I think, is very important for us to add some context. And as a matter of fact, if we go back to 1945, what we'll find is that there's been 33 corrections in that timeline. That's 77 years, which means that there's a meaningful correction where the markets have dropped by more than 10% across the board every 2 to 2.5 years. Now, we haven't had a meaningful correction until there was the pandemic, and before that was in 2018. So the more recent corrections have actually been happening in a more tight timeline, but this is really what we would call a correction, not based upon an economic event, but more for some other factors. Let me show you what I mean. When you look at this chart, which again is the S&P 500 going back to 1927, what you'll find is of these 33 corrections, 12 of them were recession-based. And again, that was because the economy was going through a slowing period, and when the correction occurred, it also fell into a recession-y period. However, there's also 21 corrections that have occurred that were non-recessionary, which meant they were non-economic. If you put that into a strategic term, so 70% of the corrections that occur are non-economic in nature and tend to also be very short-lived. If you look at the graph on the far right-hand side, you can see that the recession that we had in March of 2020 was one of the shortest ever in history. And recessions, while normal, are based on economic activities. And if we go to the next slide, I'm going to show you some of the positives that are currently happening in the marketplace. When we're measuring economic risk or recessionary risk, recessions don't happen overnight, by the way. There's leading indicators that tell us very succinctly if we're heading in that direction. These are 7 of the key indicators that we look at. There's certainly more, but these are 7 that we think have a lot of the weighting towards understanding if there's a recessionary issue heading our way. Currently, as you can see, under the present conditions, while I won't go through this in detail, only one is showing that there's a possible present condition as an inflationary or recession shock. Now, inflation is proving to be a little bit more persistent, and I would argue that the current correction that we've gone through over the last 6 weeks has more to do with the fact that interest rates are going to be rising earlier than were anticipated. The anticipation was June, and it looks like it'll be happening in March. When that happens, there's a rapid repricing of assets in the marketplace, and it tends to be a bumpy period in the initial stages, but yet very short term. In order for us to think that there is a recession coming, we have to see at least 5 of these indicators showing very positive yeses. And in this case, currently, we only see 1, which, if we look at technical factors, would tell us that a recession is unlikely within the next 4 years based upon just these factors. Now, I'm not saying that that's the case. I'm saying that's how strong the argument is that we're not heading into a recessionary period. This is the last chart that I wanted to share. this is something I think that everybody can relate to, and this is a manufacturing perspective of what is happening in the economies around the world today. If you look to the far left, you can see a lot of red. Well, that was the manufacturing industry around the world showing a decline in the manufacturing orders, which, as you can see, also aligned with the pandemic period, March of 2020 into June of 2020. The color red indicates a decrease in manufacturing, which in itself is a recessionary effect. If people aren't ordering goods, that means that manufacturing is slowing, that means that there's less capital in the marketplace, and also clearly profits are lower. As you look further right, there's a massive recovery in manufacturing today. And it could also be argued that as the manufacturing is picked up, we have rarely seen a timeline where all but 2 or 3 countries in the world today are showing growth in their manufacturing cycle. There's likely a reason that there's a problem with having the supply chain, simply because the goods that are being demanded today are at a higher level than many other times in history. When you're seeing an increase in manufacturing, that means an increase in cash flow. That means that there's an increase in profitability around the world today. And for us, that means that this is a very buoyant time to be investing. This would be one of the basis for the arguments that today the correction that we have seen is more of an opportunity to, if you have freedom of cash and you can purchase, this would be a time. But thankfully, because we're using managed programs, these programs also carry a cash component within themselves in order to deploy at times just like this. As always, if you have any questions or concerns, please contact me at any time.